Last week in the stock market, we saw a lot of red, giving us an opportunity to look at 6 undervalued, high-quality dividend stocks near their 52-week lows. We're going to analyze each one, looking at both their historical performance as well as their dividend safety. We're going to run through each one's underlying financial metrics as well. And finally, for each one, we'll run them through the valuation model, getting to our own intrinsic value, our acceptable buy price given our investor margin of safety, as well as looking towards Wall Street for each one of these 6 to see what their price target is over the next 12 months. We have also been buying some of these within our own portfolio, so we will discuss our strategies and run through which ones exactly throughout the episode. So the first one is McDonald's Corporation. As we can see, a double buy rating, seeking alpha as well as Wall Street. We do note a hold rating from Quant, and as we can see, trading right there towards its 52-week lows. Over the last 12 months, not the greatest performance, down around 10%, but if you've been a long-term shareholder, you would be up 154%. Now, do bear in mind, if you were to reinvest those dividends, it would be a slightly better performance. In terms of the forward yield, where it does currently sit around 2.59%, and in terms of the forward PE, it is around 21.15, so this is a company that does trade slightly lower than the S&P 500, which currently sits around 22. In terms of dividend safety, well, a score of 77, it does look to be safe. Market cap 186 billion. It is a mega cap company. So when we take a look at the dividend safety itself, it was just reaffirmed a couple weeks ago, 77 score, meaning that a dividend cut does look to be unlikely for MCD. In terms of the key metrics, now this is from the last recession, 07-09, they did in fact increase their dividend. They had recession sales negative 5.8%, so above the average. Remember, for the S&P during the Great Recession, this was around negative 12%, and we do note this is a very good recession stock, negative 3% return during 07-09, when the S&P itself was down around negative 55%, and this is one, if you are a regular viewer, you will know it is one of my larger positions in my portfolio. In terms of dividend growth, well, very nice to note, 9.9% in October last year, 8% over the last 5 years. And if you've been a shareholder for 20 years, at a minimum, that dividend has been increasing double digits, 15%, well above that minimum we advocate on the channel of 4%, just to keep up in line with inflation. Now, they have been increasing those dividends for 47 consecutive years, so not only are they a dividend aristocrat, but they are 3 years away from becoming a dividend king, something that does look to be extremely likely for MCD. Now, in terms of dividend yield theory, if you are a new viewer, it suggests a company is undervalued when the current yield sits above the 5-year average, 2.59 versus 2.27, so we do have our first undervaluation signal. Again, the forward P, 20.9, it is lower than the 5-year average of 25.4, so we have a double undervaluation signal. Just bear in mind, we're not looking at any of these models in isolation, and we will conclude towards the end. Consumer discretionary sector, however, it does sit at 14.3. As we can see, McDonald's is slightly higher. So in terms of the free cash flow payout, very important, and it does correlate to that dividend safety. What we are looking for this is below 60% if you do want to be industry specific for restaurants. For me personally, I have a blanket rule of 60% or lower. It does give me faith then that if it does hit that target, management can offer those lovely double-digit increases we love to see. What we know over the longer term, while it has been decreasing, it is above the 50% as well as pretty much above my own 60%. However, 2024, it is anticipated to be around 55%, and historically, it hasn't been that much higher than the 60% level. In terms of the free cash flow per share, we'll always invest in companies that over the longer term do increase those cash flows. As we can see, more than doubled, 423 in 2014, 997 in 2023, and as we can see, anticipated into 2024, a nice increase to around $12.10 per share. In terms of sales growth, well, what we want to see at a bare minimum, 3 to 7%. As we always say, if they're not hitting the lower target of 3%, they aren't keeping up in line with inflation. They have had historically bad periods of growth. In fact, quite a number of years of negative growth. More recent year, 10%, nice double digit. Hopefully this is something that they can continue to increase their top line with. And when we look at it historically, it hasn't had the best performance. What we would say, however, with this is that they do manage to increase those free cash flows, which is very important for a business like MCD. What we also note is with the shares outstanding, they have been returning excess cash to investor pockets through those share buybacks. We can see it decrease over the longer term, and hopefully this again is something to continue with this company in line with those nice dividend growths that they do offer. Do remember, when companies do those share buybacks, you are getting a larger portion of the companies. ROIC, a very important metric. In fact, one of our 7 golden dividend metrics. We want to see a minimum 10% or more. Again, industry specific, a little higher for restaurants. This does give us faith that management are able to effectively allocate their capital. With MCD, very strong consistently, the last 3 years in the low 20s, trailing 12 month 25%. Again, we can see this a very strong company. In terms of margins, now yes, they have struggled with their top line, but what they have done very nicely is not only have their margins above the minimums, but we can also see over the longer term a lot of operational efficiency. 29% was the margin in 2014, 46% in 2023, and it does look to consistently increase over time. The same can be said for the free cash flow margins. Very, very nice, increasing and very strong. 29%, 23%, 28% on a trailing 12-month basis. It does make this company very attractive to potential investors, as well as those who already invest in this company. Net debt to EBITDA. Now, EBITDA referring to the earnings before the interest, tax, depreciation, amortization. Below 3.5 is what we want to see. And remember, for those that are new, these are the number of years it would take the company to pay off all of that debt net of cash on hand. Remember, this metric also correlates to both dividend safety as well as balance sheet strength. So over the longer period, it has straddled around that. Nice to note, 2023 below at 3.13, 2024 at 3.11, also marginally lower. So as long as they maintain that with the free cash flow payout, which is anticipated to be in the mid-50s, the dividend does look to be safe, and overall the balance sheet doesn't look to be in a bad position at all. In terms of the valuation, let's jump straight into it. As always, if you do enjoy the content, values being provided, smash that like button, hit that subscribe and bell button so you are continually notified of these videos as they drop. Now, typically on the channel, we do run through every single one of these models. Today's episode, we're going to jump straight in, and the intrinsic value is essentially the average of these 3 models that you see on screen today. Current price around 258. If you're a viewer, you know we start off with a margin of 10%, and we only execute on this if we believe it meets 3 golden criteria: a wide moat, strong financial metrics, and good forward-looking data. Now, if you believe that for MCD, a buy up to $281, then we keep going till it's near the current trading price, and as we can see in today's episode, it isn't too far off a 20% margin. It is around a 15 to 20%. Now, for me personally, that is sufficient enough to add dollar cost average in this into my position. Over the longer term, I do believe this will be a very strong company, and we can see in terms of Wall Street over the next 12 months, they do see double digit, in fact strong double digit upside implied of around 20%. Their price target of $310, and as someone who already holds a position in this company, just for that transparency, I am currently adding, as I do believe dollar cost average over time in this company, it will be one that will be growing at a very rapid rate. Now, in terms of the second company that we are looking today, it is Vici Properties, a real estate investment trust. We have a double buy signal as well as a strong buy from Quant. As we can see over the last year, similar to other REITs with the high interest in rate environment that we're in, it is down 8%. Over the last 5 years, however, it is up around 24%. We can see trading right there towards its 52-week lows. We do know a forward yield just under 6% at 5.87, and in terms of a P to FFO, forward looking, it does sit just over 11 at 11.08. Now, dividend safety, 50, borderline safe. Let's touch upon that as well. Market cap, 29.5 billion. It is a large cap company, and it is one that we do hold ourselves. So for full transparency, this is in our portfolio. In terms of dividend safety, well, it was reaffirmed not too long ago, that 50 borderline safe. Now, what that means essentially is that there is a moderate risk of a dividend cut over the full economic cycle. So let's take a look at both payout as well as the net debt to EBITDA. Now, this is one that did list after the Great Recession of 07-09 around 2017. Therefore, we don't have any of that recessionary data available. Now, dividend increase 6.4% last September, 10% over the last 5 years. Nice to note that double-digit increases. So it is quite nice for a REIT with these increases. It is above as well the minimum inflationary rate we target, with 5 years of consecutive increases. Now, in terms of dividend yield theory, we do get that strong undervaluation signal on both the yield as well as the forward P to AFFO, 12.5, lower than the 5-year average. And when we do compare it, it is also marginally lower than the real estate of 13.9. Now, with other companies, we do focus on free cash flow metrics. However, for REITs, a lot more volatile. So we draw your attention to the adjusted FFO, funds from operation payout. For hotel REITs, so being specific, we do want to see around 75%. pretty much straddling around that, so that is sufficient for us. 73% in 2024 anticipated, and as part of their investor presentation analysis that we do, this is one of their targets. They do want to maintain this around 75% moving forward. In terms of adjusted funds from operation, again, similar to free cash flow, we want to see this increasing over the longer term, as we can see both historically and anticipated in the future months and years as well. So how does that look percentage-wise? Well, in the more recent year, 11% growth to that adjusted funds. And in terms of 2024, 4%. So still very healthy in our opinion. And in terms of sales growth for REITs, around 5 to 10%. The last 4 years looking very strong. And we do note the trailing 12 months showing 18%. So that top line growth doesn't look to be slowing down anytime soon. Now, in terms of numericals, we do see 2017, 200 million to their top line, 2023, 3.61 billion. So there is some very nice growth. But one thing very typical with REITs, they will dilute your position over the longer term, as we can see. Those shares outstanding are increasing at a fairly rapid rate, pretty much in line with realty income, but there are many other REITs we have reviewed on this channel that do dilute your position at a much lower rate. Something just to consider when you are analysing this in your own investment thesis, and maybe something to anticipate what your margin of safety will be. ROIC then, 3 to 5% is what the metric we use for REITs. Very strong, in fact 8% in 2023. You would give that in some companies regardless of whether they're REITs or not, so very healthy. 5% the year before, 8%, so it is typically higher than the 3 to 5% we typically see for these type of companies. Operating margin as well, very strong, 92% in the more recent year, 93% on the trailing 12-month basis. And when we do move to that net debt to EBITDA, we can understand why we see that borderline safe score. For REITs in general, we do want to see around 5 to 5.5. For hotel REITs, we bring it down to 3.5. Now look, the more recent year, 5.86, so that is significantly higher. It is anticipated to fall into 2024 at 5.43, but not at a quick enough rate, hence why we do see that dividend safety score at borderline 50. What we would say is that their adjusted funds from payout is still very reasonable at around 75%. So as long as they manage to drop down this debt level year on year, quarter on quarter, we should see that dividend safety score get higher and higher. So let's jump into their valuation and let's see what it is showing in terms of margin of safety as well as upside. Now, in terms of this model, don't forget you can click on the pinned comment below. You can grab this valuation, getting to your own intrinsic value, as well as your own acceptable buy price for companies in your own portfolio or those on your watch list. So the intrinsic value comes to $37.42. Margin of safety, remember 10% level, a buy up to $34. At 15%, a buy up to $32. At 20%, a buy up to $29.94. So we do see quite a nice MOS level with this REIT. It isn't too far off, in fact, a 25% margin of safety, which what I would say is sufficient for a high-class REIT like Beachy Properties, if it is one you do believe in over the longer term. Now, in terms of Wall Street and their forecast, well, over the next 12 months, they see some significant upside. That is why we saw a double buy rating and a strong buy from Quant. $36 is their price target, not too far off their intrinsic value, and this one, similar to the previous company, is one we have been adding to our portfolio. We do see a lot of nice upside with this margin of safety looking pretty much sufficient at the 20 towards the 25% level. But as always, with these companies we run through, do let us know your thoughts in the comments below. We do believe REITs will be looking very strong a year from now if we do see those interest rate cuts that we all anticipate. We then move on to the next company that we are looking at today. It is UPS, one that has been falling very significantly in the more recent period, down 17% over the last 12 months. Over the last 10 years, if you have been a shareholder, you would be up pretty much around 33%, so not the greatest return. We do see all-time highs around $225 in 2022. Right now, pretty much there or thereabouts the 52-week low. We have a buy rating from Wall Street, however, a double hold from the other two analysts, with a yield around 4.7% and a forward PE of around just under 17. Do let me know your thoughts in terms of the yield. Are there any type of companies that you wouldn't look at because you want to invest in companies with a minimum yield, and we can then incorporate that into our own episodes moving forward. Now, in terms of dividend safety, well, a score of 69, it does look to be safe. Market cap 119 billion, it is a mega cap company. In terms of dividend safety, well, it was just reaffirmed. It does essentially mean that a dividend cut does look to be unlikely, but remember, it does have a score of 69, so that is lower than the typicals that you would see around 80 for being safe. Key metrics, well, last recession, they maintained the dividend. They had average growth, and they unfortunately very, very marginally beat the S&P, negative 48%. So not that much difference, around negative 55. A lot of people would prefer, if that was just a very small difference, to have that security of investing in an ETF rather than an individual stock like UPS. But again, do let us know your thoughts. As we can see here, clearly a very mediocre increase to their dividend this year in January, 0.6%, significantly lower than the 4%, and even more disappointing given over the last 5 years and the last 20 years, we did see some nice double-digit increases to their dividend. Now, we do know they have increased their dividend over the last 14 years. However, they have been paying 55 years without a reduction. Now, in terms of dividend yield theory, a severe undervaluation signal, 4.7 on the yield versus the 5-year of 3.34, although we do note the forward P is only marginally lower at 15.8, and it is significantly lower than the industrial sector as a whole, that sits around 19.4. Now, in terms of the free cash flow payout, what we can see is below 60%, and again, remember, we haven't mentioned it in today's episode, but we do tend to ignore the earnings. It is susceptible to essentially manipulation by management through accounting, and you wouldn't be able to notice what we can see here. Remember, below 60% in 2023, the more recent year. What this signals to us, 110, that they have been paid out more in dividends than they generated in free cash flow. A little bit of a red flag, especially given next year they are anticipating the same. Something to consider and see whether or not the margin of safety is sufficient for investing in a company where the dividend does look a little bit questionable. In terms of free cash flow, yes, it's increased over the long term, but significant inconsistency. 2024 460, so it is anticipated to drop. Do bear that in mind. Now, in terms of sales growth, 3 to 7%, what we do know, pretty much hitting that for the majority of the last 10 years, some very strong years. However, the more recent year, negative 9% to their top line. And we can see over the longer term, nearly doubled their top line, but quite a large drop from 2022 to 2023 by around $9 billion. In terms of shares outstanding, they have done share buybacks, very inconsistent. Some years, as we in fact note, from 2019 to 2021, where they would have issued shares. But overall, the net position is in fact net buybacks over a 10-year period. Now, in terms of ROIC, very strong. In fact, over the last 10 years, very good numbers. It has been decreasing, so that is one trend we will note. Nonetheless, even 20% in 2023 still looks very attractive. In terms of margins, well, both free cash flow and operating, they have pretty much been straddling around the minimums that we want to see. But that is one thing that we would say, just keep an eye on if you are an investor or a potential investor, that quarter on quarter or year on year when the annual reports do come out, that there aren't any significant changes. Because if it does drop even slightly, it will be below that level that we want to see at a bare minimum. On a more positive tune, in terms of the net debt to EBITDA, when we are looking at the dividend safety, balance sheet strength, it is a lot lower than the 3 that we want to see generically for the majority of companies. 1.58 is anticipated to go lower to 1.49 in 2024. So let's find out what the valuation says in terms of if there is some sufficient margin of safety and upside to consider. So in today's episode for UPS, what we are getting to in terms of an intrinsic value is the average of these 3 models that you do see on screen, and today it arrives at $173. Margin of safety then at 10%, what we can see it buy up to 156, at 20% around 138, so pretty much at that current trading price. 20% margin of safety. Do let me know if UPS is one that you are sufficient with that level. For me personally, given some of the red flag indicators like the dividend safety, like essentially the drop of a lot of metrics coming down their margins, I would need a more MOS level to make this a purchase in the portfolio. In terms of Wall Street though, they do see around 19% upside. They have a price target of $166 and their yield does sit near that 5% level, so it does make it a very attractive proposition to dividend investors. As always though, do let me know your thoughts below. We then move on to a company we haven't taken a look at in quite some time. It is the oil giant BP, Beyond Petroleum. Now what we do have is a double buy rating seeking alpha as well as Wall Street. We have a hold from quant. We can see it trading in the mid to lower end of the 52-week range. Over the last year, well, it is up marginally around 2%. Over the last 10 years, in fact, like the majority of oil companies, it hasn't been the greatest, down around 27%. We do have a forward yield near 5%, 4.75 to be exact. And similar to others in the industry, it does trade at a very low forward P at around 8.06. In terms of dividend safety, well, similar to Vici Properties, we have a borderline safe score of 50, market cap 101 billion, a mega cap company. So in terms of dividend safety, reaffirmed again, as we can see, moderate risk of a dividend cut over a full economic cycle. In terms of the last recession, well, in fact, they maintained the dividend. They had significantly below average growth, negative 39%, and they marginally outperformed, negative 45%. Dividend growth, not the greatest, 0.1% last year, negative 7%, so we do see a dividend cut, and over the longer term, we do see in fact 0% year on year. And we can see the graph here, there was a massive cut during the recession, and in fact even in 2020 during the COVID pandemic, although it has started to pick up, hence why we see 2 years of consecutive increases. Now, in terms of dividend yield theory, what we have here is a sign of reasonable valuation, 4.7 versus 4.8, in terms of the forward P, 8 versus the 5-year rolling of 7.5. When we do, however, compare, the majority of others in this industry do trade a lot higher. In fact, the sector P itself does sit around 12.2. So let's take a look at some of the important metrics for the dividend safety, like the free cash flow. Well, over the last 3 years, and remember for oil producers below 40%, it has been below that. 2024 expected around the same. So we would like to see a nice increase, at least in line with inflation in 2024. In terms of free cash flow, very inconsistent. One thing though that I will say is with this industry, very cyclical, so we do anticipate peaks and troughs. And as remember, always you do want to be buying companies when they are out of favor, out of their cycle, when they are a lot lower, and then ride them to when they become in favor. And we do notice here the free cash flow is anticipated to drop into 2024. In terms of sales growth, well, as you can see here, in fact, 5 or 6, in fact, of the last 10 years have been negative growth. 21-22 very strong, trailing 12 month also looking negative at negative 18%. Total sales then, you will see that cyclicality very clearly. And over the last 10 years, both issuance of shares as well as share buybacks, although we do note the net position being those share buybacks by around 1 billion shares. In terms of looking then at the ROIC, again, very inconsistent, above 8%. They have done that over the last 2 years, although we can see the decreasing trend, 13% on a trailing 12-month basis. Free cash flow margin, operating margin, very inconsistent. Again, it is just a theme of this company as well as the industry. If you have seen our other company reviews of oil producers, you will note that this is very typical of them. Both margins straddling around, some years a lot better, some years a lot worse. Now, in terms of the net debt to EBITDA, one thing we will say, below 1.5 for oil producers, and over the last few years, that is what it has been for BP. 0.52 in 2023, although we do notice an increasing trend, 0.88 in 2024, still, however, lower than the 1.5 maximum we do want to see. So important with these companies that we are buying them at the right price. So in terms of the intrinsic value today, what we are arriving to, as we can see, the average of these three models, just over $43, which does give us some sense of security with a margin of safety. 10%, $38.75. At 15%, we can see $36.60. So not too far off, as we can see a 15% margin of safety. In terms of Wall Street, well, they believe there is a lot of upside. In fact, marginally higher than our intrinsic value. They have a price target of $44, and we can see implied upside 20%, making this a buy now in terms of what they see. But as always, let us know. In fact, you may prefer other oil giants like Shell, which has performed very strongly, Chevron or ExxonMobil, but let us know your thoughts below, as well as one of Warren Buffett's favorites, Occidental Petroleum. Now, before we continue to the others, just to let you know, we have released our latest free weekly article running through super investors' portfolio movements. If you want to grab a copy completely free, do click on that pinned comment, sign up and read. We also released other articles like undervalued dividend stocks to consider for the portfolio, as well as how to find undervalued stocks. So if you are interested in knowing all the websites that we use, all the resources, do go ahead, read and then find out. So the next one we're looking at is Deere & Company, and as we can see, a double buy rating with a hold from Quant, again trading towards their 52-week low. Over the last year, up marginally 5.9%. Over the last 10 years, up very strongly, around 311%. And we can see it has traded around $450 at its 52-week high. In terms of a yield on the lower end from what we've reviewed today, 1.57. Well, in fact, forward P pretty low, 14.7, but that is low against essentially the S&P 500. We will need to take a look at what the sector trades for to understand how it compares. Dividend safety then, 83, very safe, our first one today. Market cap, 104 billion. It is a mega cap company. Now, as we can see, reaffirmed not too long ago, in fact, February 29th, that a dividend cut does look to be highly unlikely. In terms of recession, well, last time maintained the dividend below average growth, and they did trail the S&P with their negative 65. But do let me know if you do see a recession coming around the corner anytime soon. Last full year, 16%. Last 5 years, 14%. Last 20 years, 13%. So this is a very strong dividend growth company, and a lot of people in this community do hold this stock. 3 years now of consecutive increases, but they have been holding this 30 years, or in fact paying 30 years without a reduction. Now, in terms of dividend yield theory, well, we can see undervaluation on the yield. However, the forward P pretty much trades now at the rolling 5-year average. When we do compare it to industrials, though, a lot lower, 19.4. So again, on a PE basis, this is one of the cheaper valued ones, but you could argue it may be justified that it is trading low. So let's take a look. Free cash flow payout below 40% for heavy equipment makers. 2022, remember, this is why we look at the free cash flow. They paid out more in dividends than they generated in free cash flow. 2022 on the earnings, you would be none the wiser at 18%. Nice to note, in both 2023 and expected next year, it is going to be below that 40% maximum level we target. Free cash flow per share, well, increasing. Again, very similar to oil producers. And these are companies that are very cyclical, as you will be able to see from the sales as well. Some years, double-digit negative growth. In fact, the last 3 years have been very strong. And the same rule applies. You do want to be buying companies when they are out of favor, out of cycle, and then you will see a lot of growth when they come back in. Numerically speaking, they've nearly doubled over the last 10 years, and what they have done, which we have noticed a trend with some of the companies today, they've issued shares, but they've also done share buybacks. Net position, though, as we can see, share buybacks for those shareholders. ROIC, well, it has been increasing over the longer term, so there's a nice trend, above 12%, and that is exactly what we've seen over the last 3 years, as well as on the trailing 12 months. In terms of the margins then, operational efficiency, we love to see that above 15% and increasing over the longer term. Free cash flow margin, as we can see, very inconsistent, but again, very typical with cyclical companies, something that we've also seen when we do analyze companies in this industry, like Caterpillar as well as Cummins and P-Car as well. In terms of the net debt to EBITDA, well, below 2.5 nearly every single year, 1.04 in 2023, 1.46, so we are anticipating a rise, but it goes to show their balance sheet very strong, and we can understand, in fact, why exactly this company does have a very safe dividend score. So in terms of the analysis of essentially the valuation, and don't forget, if you do enjoy the content, values being provided, smash that like button, hit that subscribe and bell button so you are continually notified of these videos as they drop. We have the intrinsic value then, 442, current price 375, 10% we have a buy up to 398. At 20%, we can see not too far off, although it isn't quite there yet. At 15%, we should say, in fact, it is a 15% margin of safety, not at a 20% level. However, for this to be one that I would buy, I would be looking around that 20% level, around the $350 mark. Right now, though, in today's episode, it does sit at 15%. Again, a very strong company that I would suggest to consider, but only at the right price. And remember, it is very cyclical. In terms of Wall Street, well, they believe the share price in the next 12 months won't be too far off our intrinsic value. They have upside of 15%, but again, when we're looking around more of a 20% margin of safety, that will boost the upside, so we will sit patiently with this one. But as always, let us know your thoughts, whether or not you are looking to add this into the portfolio. We then move on to a company that we haven't reviewed on the channel yet. It is Constellation Brands, and we have a double buy rating, quite a strong one, in fact, from Wall Street at 4.4 out of 5, a hold from Quant. It is trading in the mid to lower end of the 52-week range. It does have a lower forward yield than some of these today at 1.63, with a forward P of 18.2. And we can see over the last year up 7%, over the last 10 years up 195%. And we can see it is a little bit away, not too much from their all-time highs of $275. So let's take a look. Dividend safety score 70, market cap just under 46 billion, a large cap company. And we do note their dividend safety was reaffirmed last month. A dividend cut does look to be unlikely for this company. In terms of the last recession, well, they didn't pay a dividend, so no comparative data. Below average growth, negative 28%, and a near recession return at negative 50 versus the S&P's negative 55. Now, in terms of their latest increase, their dividend was just last month, 13%. Love to see that. Over the last 5 years, at a minimum, they are increasing it in line with inflation. In terms of paying a dividend, 3 years of consecutive increases, 8 years without a reduction. And when we take a look at dividend yield theory, we do notice a double undervaluation signal on the yield as well as the forward PE. And when we compare it to consumer staples sector, it is pretty much in line. But remember, we don't look at any of these models in singularity. Now, in terms of the free cash flow payout, what we can see below 70%, so we do bring it higher than the 60 for consumer staples. Every single year, in fact, below 50%, a very positive sign. 2025, the next financial year, 40%. Again, looking very healthy, so we can anticipate nice double-digit increases to their dividend and a beautiful free cash flow graph. In fact, more than quadrupled over the last 10 years, expected to increase again next year. A little bit inconsistent in the more recent period, but overall, we do want to see companies with consistent and very, very nice increases to those metrics. In terms of sales growth, well, 3 to 4% as a bare minimum, 3 to 7 ideal. They have pretty much hit that nearly every single year, so we do quite like to see that. It is something that we do gain confidence in predictability. In terms of sales, well, it has increased 50% over the longer term. At a bare minimum, it is increasing in line with inflation. And as we can see, again, very typical, share buybacks, share issuances, net position though, and marginal share buyback. Now, when we take a look at the ROIC, consistency is what we love to see. Looking like a bit of a theme with Constellation Brands, around 12% level over the longer term. Last 3 years, very strong, 14% on a trailing 12-month basis. Again, things that we do like to see. Well, very good, above 16% consistently and in the low to mid 30s over the more recent period. Again, operational efficiency. Same can be said about the free cash flow, above 7%, although we do note it has been decreasing since 2021. Still, nonetheless, 15% looking very solid. Maybe something you might want to keep an eye on when they do release their next annual report. In terms of consumer staples, not just the dividend payout that we increased to 70, but also the net debt to EBITDA below 4 as opposed to 3. What we can see, in fact, below that, 3.13 in 2024, 2.89 in 2025, so again expected to drop. Overall, it does look pretty strong, so let's jump into the valuation, see what is cooking with this margin of safety. And remember, as always, you can grab a copy of the valuation model by clicking on the pinned comment below, getting to your own acceptable buy price as well as intrinsic value. Now, margin of safety at 10% with a current price of $249, it is a buy up to $260. At 15%, a buy pretty much a few dollars shy of the current price, so it isn't too far off trading a 15% margin of safety. In terms of Wall Street, well, they anticipate 21% upside. They, in fact, see very strong growth to their share price, well above our intrinsic value at 21%, 302 as their price target over the next year. But as always, let us know your thoughts in the comments below. Do you buy any of these over the more recent period? Are any of these on your watch list? Or maybe some of these are new stocks that you are going to take a further look. As always, if you've enjoyed today's episode, smash that like button, hit that subscribe and bell button. And as always, we'll see you all on the next one.